Hello everyone, this is John Muntz with Dealer's Edge. I want to welcome you all to what I hope is going to be a series of workshop summaries in which we take one of our online workshops and produce a video summary of the material provided. In case you haven't heard of us, Dealer's Edge is a firm dedicated to informing dealers and dealership management on topics relevant to your bottom line. We are always producing new content via our online workshops and webinars. You can find out more about us at dealersedge.com/VIP. For our first summary, I chose one of our most popular topics presented by one of our most popular presenters, Brooke Samples of Profit Blueprints LLC, and the topic is the financial statement for dealership managers. Dealer's Edge members have access to the full 1-hour workshop as well as the executive summary, which is what is being read here, in PDF format. Not to mention hundreds of other topics targeted to dealership owners and managers. Rob Keeley, an industry expert himself, wrote the summary, and the narration is done by Darius Jackson. Relevant links will be in the description below. I plan to create many more of these, so please like, comment, and subscribe to stay informed of new releases and to help the channel grow. So, all that aside, let's get into it.
Dealer's Edge Automotive Financial Statement for Managers. For many managers, reading financial statements is like reading hieroglyphics. They know that there's insightful information in there that can help them do their job better, but can they interpret it? Fortunately, you don't need a Rosetta Stone or an accounting degree to break the code. You just need to know a few basics. Brooke Samples, president of Profit Blueprints LLC, joined us for an online workshop to help us better understand dealership financial statements. Over the course of her long career, Brooke Samples has worked with Lloyd Schiller's Dealer Service Corp., NCM, and VW University, and as president of Profit Blueprints, has analyzed over 15,000 dealership financial statements and coached and motivated hundreds of dealership managers in all departments across North America. Using her monthly financial analysis, Profit Blueprints, she compares dealers' financial statements to key benchmarks. She then uses her vast reservoir of experience plus feedback from her clients to help managers utilize over 100 action plans. This report is a summary of Brooke's comments and suggestions. If you don't have regular and accurate financial statements, you're driving your business 100 miles an hour down a one-way street the wrong way at night in the fog without lights. Jim Blazingame, author. Reading, understanding, and analyzing patterns in your financial statements is the key of top-performing dealership management. If you are just looking for a couple of ratios or target numbers, you're missing a lot of opportunity. In this workshop, Brooke showed us what happens when you sell something. Follow the transaction through the financial statement. What happens? Why? What happens when you buy something? How does that evidence itself in the financial statement, and why is it important? Best practices for comparing the financial statement to your departmental reports and DOC. Why they are different. When you should and should not worry. How to keep the financial statement accurate with daily self-audits. Nothing worse than managing with corrupt data. How to read the balance sheet accounts, and how this knowledge can impact your performance. When and why to compare your statement to benchmarks and targets. The basics. As managers, we deal with a lot of reports with financial data. But what exactly is a financial statement? While statements come in all sizes, from a few pages to 12-page behemoths like Mercedes, they're all made up of two parts. The balance sheet reflects all transactions and is typically page 1. The income or profit and loss statement, which shows sales and expenses. The income statement is broken down into the following general categories: sales, gross profit, expenses, net income, also called selling gross profit, Ford, or department profit, CDJR. And it follows a formula. Gross profit minus expenses equals net profit. All of the combined income statements results flow into the balance sheet and appear on a single line, current year's profit. The balance sheet shows the following: assets. Liquid assets can be converted into cash. Fixed assets, that are not expected to be converted into cash in the next 12 months, minus liabilities, short-term debt that will be paid back within a year, like bills, etc. Long-term debt, which takes more than 12 months to pay back, like a mortgage, equals net worth. Why is the financial statement important? It's your report card. It reflects everything that is in a dealership from a financial standpoint. Pay plans often use the data to establish compensation, gauges the health of the business, and identifies areas of opportunity. Important when applying for loans and can determine what interest rates you pay. Can affect how much tax you pay or keep if you're audited. So how do sales show up on the financial statement? Good question. Brooke walked us through a typical car sale with a trade. A car that cost $18,000 is sold for $20,000 for a gross profit of $2,000. And the income statement would look something like this. So how does it show up on the balance sheet? If this was the sole business transacted, it would look something like this. The $20,000 car was paid for by a combination of $2,000 cash, a $12,000 loan, which is called contracts in transit, and a $6,000 trade called used vehicle inventory. The cost of the car was $18,000, called new vehicle inventory. The total assets shows the $2,000 profit from the sale, which equals the liabilities and net worth of $2,000. To illustrate how cash moves around the financial statement, consider what happens when the bank pays the dealer the $12,000 that the customer borrowed. Contracts in transit goes to zero, and cash goes to $14,000. In this case, the new vehicle was purchased from another dealer for $18,000 and now needs to be paid, and unless I sell the used vehicle, I'm overdrawn. Uh-oh. Being overdrawn too many times can create problems, so it pays to have enough cash in the bank to cover fluctuations in cash flow. Once the used vehicle is sold, it replenishes the cash. When the $400 commission is paid on the income statement, it shows up as a payroll liability on the balance sheet. When the check is cashed, the total assets on the balance sheet are reduced to $1,600. As a general rule, expenses are arranged on the income statement from the most controllable, like variable expenses, to the least controllable, fixed expenses. When put into the perspective of percent of GP, it makes it easy to track and evaluate to ensure that they are consistent with your guidelines, since every dollar trimmed from expenses is $1 less that you have to earn through selling something. So how does a service repair flow through the financial statement? Consider this tire sale. In this example, we had a labor sale of $45, a parts sale of $850, a miscellaneous sale of $12, and an adjustment or discount of minus $24, evenly split, 12 each, between parts and service for a grand total, including tax, of $940.40. The income statements for this transaction look something like this, with $12 each coming off the labor and parts sale. So instead of collecting $45, the service department collected on $33 for installing the tires. Brooke noted that the proper place to apply discounts is against the sale, rather than to advertising and promotion. While this seems wrong, the advertising account is for the cost of conducting the promotions, such as printing and mailing expenses, rather than the discount given to the customer. And this makes sense for a couple of reasons. It keeps the sales and gross amounts accurate. It ensures that compensation calculated from the sales or gross is accurate. Analysis of the income statement shows that when the $10 commission is paid to the service advisor, it absorbs 56% of the $18 gross profit made from the sale. The $2 charged for supplies, such as wheel weights, etc., shows as minus $2 because it reduces that expense charge. In this case, the net profit from the transaction is $2, or 13% of the gross profit. While not bad, it's also not the 20% benchmark, which is why having a plan to maximize the yield on low margin opportunities with complementary services such as alignments, road hazard protections, etc., or found work such as brakes, etc., is important. Dealership department reports. Managers rely on DMS-generated system reports to manage their departments, but often they don't match the financial statement. Why? In this example, the service manager experienced a large variance between the gross profit on the DMS report and financial statement. Some reasons could be that the technicians are costed wrong. For example, it is not unusual to find that hourly technicians show zero cost. Production CSI sales bonuses are not accounted for on the production report. Accounting entries such as backed out warranty repair orders, adjustments of work, labor, and process, adjustments made to repair orders after close, discounts posted to the wrong account. So how does the service manager fix this? Well, not all can be. However, some tips for reducing the variances are: make sure that the tech hourly cost is correct. Maybe the rate from 22 to 24 was never changed in the DMS report. Flag clock hour techs at their average rate based on cost. For example, a $10 hour tech is paid for 40 hours, but only produces 20 hours. His average cost is $20 an hour. If techs are assigned tasks such as training, equipment maintenance, janitor, etc., move their costs for that project to the appropriate expense account. Adjust costs to reflect consistent bonuses. Tech TJ always hits a production bonus of $2 per flagged hour. Any adjustments to sales or gross must be signed off by the department manager. For example, if a service advisor decides to offer a discount or not charge for a repair, the manager must first approve it. Verify DMS settings. Send entries to the correct accounts. Assume nothing. Dig deeper if something doesn't look right. Reconcile the work in process on the general ledger to labor paid on open repair orders every month. Run exception reports daily to catch errors in real time. Set them to run in the nightly job stack. Service CDK equals REX. R&R equals 3619. Parts CDK equals ROV. R&R equals 2542. So how does the sales manager ensure that his sales summary report matches the financial statement? Start by ensuring that the closed sales are posted to accounting. Some reasons for the variance could be internals posted after the deal was sent to accounting, WEOs not allowed for in the deal, receivables not collected/rebate adjustments, the deal was backed out from the previous month, finance income adjusted by finance source, reserves, free oil changes, etc. So what can the manager do? Employ a recap sheet with every deal. Accounting verifies the accuracy of the deal. Any write-offs must be signed off by the department manager. Accounting notifies finance when a finance source pays reserve or notified reserve amounts vary from the amount set up. Understand where document fees and PACs are accounted for in the statement. Spot check by comparing the vehicle sales journal to the actual sales report. Daily Operating Control, DOC. The DOC is an important tool for managing the department, so it is vital that it match the financial statement. Brooke recommends that a secondary DOC with more accounting detail be set up to provide better clarity to key accounts. For example, maybe there is a value in knowing what is going into various sub-accounts for advertising such as paper expense, internet, or payments to various vendors. Compare the DOC to the department reports to highlight variance in close to real time. Compare recap sheets to the DOC. Manager responsibilities. To be relevant, the financial statement must be accurate, complete, and timely, so it is critical that managers turn their paperwork in as soon as possible. Review the schedules regularly. Sales, receivables, rebates, and inventory aging. Deals in process. Keep it clean. Service, parts, body shop. Receivables, aging. Open repair orders, aging. Parts inventory reports. Special order aging. Review your direct staff's paychecks detail report. Insist on authorizing expenses. Review key expenses weekly. Use schedules or detail reports. Review details on advertising expenses. Review policy expense. Accounting responsibilities. Notify managers when entries are made that impact their departments. Use a checklist to confirm all normal expense bills and invoices are posted before closing the month. Reconcile assets and liabilities like bank statements, receivables, payables, inventories, etc., at least before the end of the month. Accrue for payroll and bonuses. If payables receives a statement and has no matching invoice, get the invoice and make sure that the manager authorizes it. Make sure the payables clerk is familiar with expense accounts as a backstop to catch errors. Allocate fixed and overhead expenses fairly. Putting performance into perspective. To understand performance and to ID areas of opportunity, it's useful to compare yourself to something. Some common methods are your historical data and trends, industry metrics, other dealerships in your group, your targets and goals, 20 groups, CPAs, outside sources like profit blueprints. Actionable information must be compared to something. Sales, gross profits per unit, units sold as a percent of last month and last year's average, days supply, finance, percent penetration, contracts sold as percent of unit sales, gross per unit retail, service, parts, body shop, gross profit retained. Is it too good? Could be a red flag. Is it too bad? Needs investigation. Expense control. Are they in line with expectations, targets? The best targets come from comparing yourself to yourself. How do they compare to year-to-date totals? How do they compare to previous years? Frozen capital. Are they in line with expectations, targets? Are they too much relative to sales? Are they too old to sell or collect? Conclusion. To better understand how financial statements are organized, Brooke recommends look at a blank statement and then study your statement. Take advantage of other Dealer's Edge webinars that deal with other aspects of the financial statement analysis. How to get more smart data from your DMS. How to turn balance sheet profits into hard cash. Expense control. When sales are soaring, many lose focus on controlling the controllable. Benchmarks and key performance indicators. A deeper look at the Every Manager tool. What fixed ops managers need to know about the financial statement and analytical reporting. How to fine-tune the new vehicle departments to spot weaknesses and supercharge results. Be active in getting the answers that you need to be a better manager. When you make a change, think about how it will affect your department and where it will show up on the financial statement. For example, add a tech. I expect to increase sales and gross profit. I expect to increase personnel expenses. Increased net profit. Increase advertising. I expect increased unit sales and gross profit. I expect more factory income. I expect increased advertising and variable personnel expenses. Increased net profit. Everything shows up on the financial statement selfie. So doesn't it make sense to make it as accurate as possible?
Okay, that's going to do it. Again, this was just a summary of the material provided. The full workshop goes into much more detail. Please check out Brooke samples at profitsfordealers.com or just search Profit Blueprints. Or Rob Kiwi's info can be found at fixedopsolutions360.com. And to look into becoming a Dealer's Edge member, it's dealersedge.com/VIP. All the links are down below in the description. Please remember to like, comment, and subscribe to keep this thing going. I'm John Muntz with Dealer's Edge. Goodbye for now.